A speculative position in Singapore drained 93,000 crore rupees worth of dollars from India's national reserves. This report covers the two rupee markets, one visible, one in shadow. The arbitrage trade that connected them, the central bank's overnight crackdown, and the structural flaw that ensures this will happen again. By the end, you will understand how a risk-free bet for a handful of banks put the entire Indian economy on the brink.
So that's the central question, isn't it? How can a purely financial bet happening in a totally different country physically drain real money from India's reserves? To get to the bottom of it, we have to start with the official regulated market. Right, this is the world the Reserve Bank of India, or the RBI, can see and control. It's a system that's built around one of India's most fundamental economic realities.
Okay, just imagine for a second that India is a massive factory, and the most critical raw material it needs to run is oil. Well, we import about 85% of that oil, and it's all priced in US dollars. This simple fact creates a constant, relentless, day-in, day-out demand for dollars, and that's what puts the fundamental pressure on the rupee's value.
Now, the official way this works, the onshore system, isn't like a stock market where anyone can trade. For a company to get its hands on dollars, it has to go to a bank with a real invoice for a real import. And here's the key thing to understand. No physical cash ever crosses the border. The rupees stay in India's banking system, and the dollars stay in the US system. The entire trade is just a series of ledger entries. And because every single official trade has to go through these banking channels, the RBI has a perfect view of everything. It knows who's buying, who's selling, and it can jump in at any time to buy or sell dollars itself to keep things stable. It's basically the system's all-seeing load balancer. But what happens when there's a market it can't see? And that brings us to this parallel universe, the shadow market. It was literally created to get around all the rules and restrictions of the official system, and it works on a totally different principle. So in the official onshore market, the main tool for managing risk is called a forward contract. Let's say you're an exporter and you know you're getting paid in dollars next month. You can use a forward contract to lock in an exchange rate today. When that contract expires, you actually exchange real dollars for real rupees. It's deliverable.
Now let's look at its offshore twin, the Non-Deliverable Forward, or NDF. This is a whole different beast. It's a pure bet. No currency is ever actually delivered. The two sides just agree on a price, and when the time comes, they settle the difference, the profit or loss, in cash. The crucial thing here is you can bet on the rupee's direction without ever touching a single rupee.
So the difference is just night and day, right? The onshore market is physical, it's regulated by the RBI, and it's tied to real-world trade. The offshore NDF market is a financial derivative. It's cash-settled, completely invisible to the RBI, and it is purely for speculation. Think of it like the difference between buying an actual stock versus just betting on which way its price will go.
And because no one's exchanging the full principal amount, traders can build up these absolutely gigantic positions. I mean, we are talking about a single bank holding a notional position of $5 billion. Their actual capital at risk? Just a tiny fraction of that. Maybe 1 or 2%. It's just leverage, pure and simple.
So, for a while, you had these two separate markets just coexisting. But then, a key regulatory decision created a bridge between them. And that's when traders figured out a way to basically print free money. You see, the RBI noticed that this offshore NDF market was getting so big that it was starting to influence the real rupee price back home. So, they made what seemed like a logical decision at the time. They allowed Indian banks to start trading in the NDF market. The idea was that these banks would naturally close any price gap between the two markets, keep everything aligned. Yeah, that's not quite what happened.
Instead, the banks came up with this perfect risk-free trade. It's beautifully simple. You look at your screens and see the rupee is weaker offshore, say 93.5. At the same time, it's stronger onshore, maybe 93.0. So what do? You buy dollars cheap in the official Indian market, and at the exact same instant, you sell them at the higher price in the offshore NDF market. That 50 paisa difference? That's pure, guaranteed profit with zero risk.
It really seemed like a clean, elegant trade, you know? A victimless crime happening in the world of high finance. But there was a massive cost, and it was being paid in secret by the entire country.
Here's the fatal flaw that was hiding in plain sight. Step 3 of that trade, buying dollars onshore, that wasn't just some paper transaction. The banks had to place real buy orders in India's actual foreign exchange market. These weren't orders to pay for imports. They were purely speculative positions disguised as legitimate demand.
So every single dollar that a bank bought for this arbitrage trade had to be supplied by somebody, and that somebody was the RBI, which was selling from its own national reserves to meet this completely artificial demand. The arbitrageurs were literally draining India's Forex reserves to fund their risk-free trade to the incredible tune of over 93,000 crore rupees.
So when the RBI finally looked at its plunging reserve levels and realized what was going on, it didn't just act. It pretty much dropped a bomb on the entire market.
The response was sudden and it was brutal. The NDF position limit for banks was slashed from billions of dollars down to just 100 million, and it was effective immediately. Other loopholes were slammed shut. The free money party was over, just like that, and the banks were now completely trapped. They had to get out of these huge positions, but the exit door had just been locked and bolted.
The morning after the crackdown was absolute chaos. The rupee collapsed by a full rupee at the open, not because of some big economic news, but simply because banks were being forced to dump their trades. The currency then swung violently back and forth all day, a full 1 rupee round trip driven entirely by a change in regulations.
So the RBI did manage to stabilize things, but it really only treated the symptom, not the disease. The underlying problem that allowed this whole mess to happen in the first place is, well, it's still very much there.
The funny thing is, the RBI now finds itself in a total mirror image crisis. For years, its main problem was a strong rupee, so it was always buying dollars to protect exporters. Today, the problem is a weak rupee, so it's selling those same dollars to prevent a collapse. It's fighting the exact opposite battle, but with the exact same tools.
And this really gets to the core paradox of the whole situation. India restricted its currency market to try and control the rupee. But those very restrictions, the tough rules, the paperwork, that's what created the demand for an unregulated offshore shadow market in the first place. And now, that shadow market has grown so large that it can actually dictate the fate of the real market back home.
The real solution isn't more caps or more little limits. There are really only two fundamental fixes. One is geological. We find a massive amount of domestic oil and basically eliminate that constant demand for dollars. The other is political. We summon the will to fully open up our capital markets and internationalize the rupee, creating a market so deep and liquid that a few players just can't push it around anymore. Until one of those two monumental things happens, every other action is just a temporary fix, a bandage on a broken pipe. The structural vulnerability remains. And as this quote suggests, it's probably not a question of if this will happen again, but when and how.